If you are holding a large amount of cash right now because it feels safe, this may be uncomfortable to hear, but it is important. Cash is no longer the low-risk choice most people believe it is. In fact, quietly and without headlines, holding too much cash has become one of the most expensive financial decisions you can make going into 2026. Not because the money disappears overnight and not because of a dramatic crash, but because of something far more dangerous. Slow, consistent erosion that most people never notice until years have passed. For decades, cash was treated as stability. You saved it, you parked it, and you waited for the right moment. That thinking made sense in a world where inflation was low, interest rates moved slowly, and global financial systems were more predictable. But the environment has changed. The rules did not change loudly. They changed quietly, through incentives, policy decisions, and long-term trends that reward people who move early and punish people who stay still. The biggest misunderstanding most people have is believing that risk only comes from volatility. They look at assets that move up and down and assume danger, while looking at cash and assuming safety. But risk is not just about movement. Risk is about loss of purchasing power, missed opportunity, and falling behind a system that continues to move forward whether you participate or not. Inflation is often talked about like a temporary inconvenience, but in reality it is a permanent feature of modern economies. Even at modest levels, inflation compounds against cash every single year. That means money sitting idle is quietly losing what it can buy, month after month. When inflation runs at 3 or 4%, that does not sound dramatic. But over 5 or 10 years, the loss is significant. And when inflation spikes, even temporarily, the damage compounds much faster than most people expect. At the same time, interest paid on cash rarely keeps up. Savings accounts may offer a yield, but after taxes and inflation, the real return is often close to zero or negative. This creates a situation where doing nothing feels responsible but produces a negative outcome. That is one of the most dangerous financial traps, because it does not feel like a mistake while it is happening. Smart money understands this distinction. Large institutions, pension funds, endowments, and long-term investors are not avoiding cash because they dislike it. They still use it for liquidity and flexibility, but they are minimizing excess cash because they understand opportunity cost. Every dollar sitting idle is a dollar not working, not compounding, and not participating in long-term growth. Opportunity cost is one of the least emotional but most powerful forces in finance. It is not about what you lose directly, but about what you fail to gain. When someone holds too much cash for too long, the cost is invisible. There is no statement showing what could have been earned. But over time, that invisible cost becomes the difference between financial progress and financial stagnation. Another reason this matters right now is the structure of the global economy. Governments around the world are managing high debt levels, aging populations, and rising costs. One of the most common tools used to manage these pressures is allowing moderate inflation to persist over time. This reduces the real value of debt, but also reduces the real value of cash. In this environment, cash holders are effectively absorbing part of the system's adjustment cost. This does not mean panic, and it does not mean abandoning discipline. It means understanding incentives. The system rewards those who deploy capital productively and penalizes those who remain entirely passive. This is not new, but the gap between the two outcomes is widening. What smart money is doing differently is not chasing hype or speculation. It is not about jumping into whatever asset is trending on social media. It is about positioning capital in places where it can maintain purchasing power, generate real returns, and benefit from compounding over time. One of the quiet shifts has been toward assets that produce cash flow, not flashy returns, but steady, predictable income that grows over time. This includes high-quality businesses with strong balance sheets, pricing power, and consistent demand. These types of companies can raise prices modestly over time, which allows their revenues and profits to keep pace with inflation. Cash cannot do that on its own. Another area has been real assets, not because they always rise quickly, but because they tend to hold value in inflationary environments. Real estate, for example, is not just about appreciation. It is about income, utility, and replacement cost. When construction costs rise and land remains scarce, existing properties become harder to replace. Over long periods, that dynamic has helped real estate maintain purchasing power, even through economic cycles. Commodities and infrastructure also play a role, not as speculative trades, but as structural components of a diversified portfolio. Energy, transportation, and essential materials are embedded in the functioning of the economy. Their prices fluctuate, but over time they reflect real demand and real costs. Smart money does not bet everything on them, but it understands their role as a hedge against currency erosion. Another important shift has been toward inflation-protected instruments and short-duration investments that adjust more quickly to changing rates. These are not exciting assets, but they serve a purpose. They reduce the drag that inflation places on idle capital while preserving flexibility. This is a more nuanced approach than simply holding cash and hoping conditions improve. The key difference is intentionality. Smart money treats cash as a tool, not a destination. It is used for emergencies, near-term expenses, and strategic opportunities. But excess cash is viewed as a temporary state, not a long-term plan. This mindset shift alone can change financial outcomes dramatically over time. For the average person, this does not require complexity or constant monitoring. It starts with understanding personal timelines. Money needed in the next 6 to 12 months belongs in cash or cash-like instruments. Money needed years from now does not. Mixing these two purposes is where inefficiency begins. Discipline matters more than prediction. No one needs to forecast markets perfectly. What matters is consistency, diversification, and staying invested through cycles. Compounding rewards time, not timing. The longer capital remains productively invested, the more powerful the results become. Another reason holding excessive cash is risky is psychological. Cash creates a false sense of control. It feels flexible, but it often leads to hesitation. People wait for the perfect moment, the perfect signal, the perfect level of certainty. Those moments rarely arrive. Meanwhile, time passes, and opportunities quietly compound for those who act with reasonable confidence rather than perfect clarity. This is why education matters. When people understand how systems work, fear loses its grip. Investing becomes less about emotion and more about process. A simple, well-structured plan implemented consistently will outperform indecision almost every time. It is also important to separate volatility from permanent loss. Assets fluctuate. That is normal. But long-term ownership of productive assets has historically rewarded patience. Cash does not fluctuate, but its real value declines steadily. One risk is visible, the other is hidden. Smart money focuses on the hidden risks because those are the ones most people ignore. This does not mean ignoring uncertainty. It means pricing it in. Diversification exists for a reason. No single asset is perfect. But a thoughtful mix reduces dependence on any one outcome. Cash alone is not diversification. It is concentration in a single asset with a guaranteed long-term decline in purchasing power. As 2026 approaches, the gap between informed and uninformed financial behavior is becoming clearer. Those who understand incentives, compounding, and opportunity cost are positioning themselves quietly. There is no excitement, no urgency, and no noise. Just consistent allocation aligned with long-term goals. Those who rely solely on cash are not doing anything wrong intentionally. They are following outdated assumptions in a new environment. The cost of that mismatch grows every year. The solution is not extreme action, it is gradual adjustment, reducing excess cash, increasing exposure to productive assets, and aligning money with time horizons. Small changes implemented early matter more than dramatic moves made late. Financial progress is rarely about bold predictions. It is about alignment, patience, and discipline. Cash has a role, but it is no longer the default safe haven people assume it to be. Understanding that difference is one of the most important financial insights of this decade. The responsibility ultimately rests with the individual. No system forces anyone to hold cash. It is a choice, often made out of caution, but caution must be informed. When the environment changes, strategies must evolve. Long-term wealth is built quietly, through efficient decisions repeated over time. It rewards those who respect reality rather than comfort. Holding cash feels comfortable. Deploying capital thoughtfully feels uncertain. But history has shown which approach builds resilience and which slowly erodes it. If this perspective helped clarify how money actually behaves in today's world, take a moment to like the video so more people see it. Share your thoughts or questions in the comments and subscribe for more grounded, long-term financial thinking without hype.